triangle price action going back to 2008. There is a definite, absolute breakout of this triangle going back to 2008. It looks pretty elegant here. We've touched it in 2011, we touched it in 2020, and now we have broken out decisively. I don't think we're going to break back below into this triangle anytime soon. But here's the really exciting chart that I found on Gold Charts R Us. You can see here, this is the platinum price action going back to 1880. Actually, in 1880, platinum was $1 an ounce. Now it is $1,500, $1,450, something like that. You can see here a very elegant trend line going back to 1890, about 135 years. I said 125 years, and I was wrong. It's 135 years. But here's the real interesting part. You can see here, whenever platinum reaches an apex going or threatening the upper side of these trend lines, you can see here that these are when silver to gold or gold to silver reaches around 15 to 1 or close to it. This happened in 1919 after the Great War. Some people call it World War I. Today, we're going to cover platinum because something very interesting is going on in platinum, and the fact that certain officials in the Federal Reserve don't know basic arithmetic or don't know basics on what is going on in the aorta of the banking system structure. That is where all of the liquidity originates and flows through every single night. It is the biggest artery in the entire global banking system, and some officials on the Fed are unaware of what its purpose is or what it needs to continue to supply that liquidity to the rest of the system. Meanwhile, the Treasury has raised $0 net since the debt ceiling was raised on July 3rd or 4th or whenever it was. The Treasury still has not raised any money, and the Treasury general account, the checking account at the Fed, is still descending. It is still just below $300 billion. It will be raised to about $800 billion by September, says certain officials at Deutsche Bank, I believe. So that's $500 billion to be sucked out of the banking system by September. I don't think the banking system can withstand that amount of drainage without a liquidity crunch.
Hey, while gold and silver dominate headlines, platinum is quietly setting up for a historic breakout. A technical trend stretching back to the early 1900s has just been breached, signaling massive upside potential. Analysts are now eyeing a long-term target of $5,000 per ounce, an extraordinary move from current levels. This bullish move coincides with growing geopolitical instability, especially involving Russia, which produces 20% of global platinum. With rising delivery volumes on the COMEX and increased industrial demand, the setup is compelling. Platinum is no longer the forgotten metal. It could soon be the canary in the economic coal mine.
But in the meantime, liquidity continues in the system because the Treasury has not raised any money yet. They were not in an emergency situation as they were during the last debt ceiling raise when the Treasury's balance was something like $50 billion or less. Now it is still just around $300 billion. That is still plenty of liquidity to spend before they have to raise any more money in an emergency. But what I did this week was I looked at the long-term price action in platinum, and we have a beautiful trend line going back to the beginning of the 20th century that we have tagged the trend line on recently, and now we are on our way higher. A big triangle breakout has happened. It is undeniable now, and what is a decent target for the end game for platinum? Well, judging by the price action since 1900, it's about $5,000, at which point we should see something along the lines of a 15 to 1 silver ratio, and I will show you how these 15 to 1 silver to gold to silver ratios line up with price action in platinum going back 125 years. And finally, we're going to cover Japan, which is edging ever closer to hyperinflation. Food prices in Japan are out of control. Even though they seem to have the larger price indexes under control, food prices are not under control at all. And what happens primarily in hyperinflation is food prices go out of control, because who cares about the price of anything else when you can't afford food?
Every night, roughly $3 trillion in repos flows through a vital artery of the banking system. This aorta, the secured overnight funding market, is what keeps global liquidity alive. Yet astonishingly, some Fed officials appear unaware of its central role or underestimate the reserve levels needed to keep it functional. One official recently suggested $2.7 trillion is ample. But actual nightly activity already surpasses that. If reserves dip below that level, the system could seize up. We're playing a dangerous game of arithmetic ignorance with the heartbeat of global finance, and the consequences could be systemic if miscalculated.
We have here what I call a WTF on reserves. I've been stressing for a while that the amount of reserves in the banking system must be more than the amount of repos that trade hands every night. I call this the aorta of the banking system. There is no other nightly exchange that shifts nearly $3 trillion between banks every night. This is it. This is the pipe which feeds all other pipes, ultimately, monetarily speaking. And we have a basic arithmetic error which suggests to me that even the Federal Reserve Board does not know how the banking system works. Either that or they send out trial balloons of idiots who don't understand anything to speak to the public to see if the public reacts to these inane statements that make no arithmetic sense. We have here an article from Bloomberg titled Fed's Waller, I think his name is Christopher Waller, backs balance sheet runoff shift in composition. So we have here, but here is the kicker in the final paragraph, bank reserves, which Waller said are currently abundant or above the ample level that the Fed strives for, should ideally be around 2.7 trillion. Now, what is wrong with that number? I'll tell you what's wrong with that number right now. 2.7 trillion is not enough. Why is it too low? Well, this is the volume of repos, of the secure overnight financing volume. That's cash that is traded for treasuries and vice versa every single night. It is fed and funded by bank reserves. The $2.7 trillion line I put in red over here, and you can see that we have been over that line consistently.
Since the debt ceiling was lifted in early July, the U.S. Treasury hasn't raised new money yet. Its general account at the Fed has stayed below $300 billion, but that's expected to jump to $800 billion by September. This would extract $500 billion from bank reserves, tightening liquidity dramatically. Why hasn't a crunch hit yet? Because the Treasury is still spending down reserves rather than issuing new debt. When that shift comes, the system will feel the pressure. This quiet before the storm is masking a liquidity time bomb with enormous implications for markets and interest rates.
Since June 18th, and we have not gone below it. Same thing yesterday and today. We are still above 2.7 trillion. If bank reserves go down to 2.7 trillion, we are currently above 2.7 trillion in nightly repos, then there's going to be a repocalypse, a crash of some sort. So, our 2.7 trillion is not enough. Now, what are these Fed officials thinking when they say 2.7 trillion reserves is what I think is abundant or ample, whatever the hell term they use? I don't understand why they say these things if they actually believe them or if they're being paid to say stupid things to the public. You have as good a guess as me. But anyway, why haven't we seen a repo crunch yet? Or a crunch of any sort, and that is because since the debt ceiling, the Treasury has not actually raised any money. Yes, the national debt has gone up something like $450 billion, but that is strictly an accounting gimmick. Now, they have accumulated all that debt before the debt ceiling raised, but they've used extraordinary accounting measures to hide it. And now they are no longer lying about that debt accumulation. And so they just put it on the national debt, $450 billion. It doesn't mean they raised that amount of money since the debt ceiling raised, but it does mean that that debt has already been accumulated. Once they start raising money net, then you're going to start seeing trouble in the repo market. You can see here we are at $296 billion, and there's been no uptick in this amount of money since the debt ceiling was raised around over here on July 2nd. And because of this, because the Treasury has not raised any money from bank reserves yet, we can see bank reserves edging higher since the debt ceiling was raised, and that was around here at this little turn over here. Once this line goes below $3 trillion, then we're going to be in some serious trouble. We're now at 3.4 trillion, and it will stay there as long as the Treasury refrains from raising any money with Treasury bills.
A Bloomberg article featuring Fed Governor Christopher Waller claims reserves are abundant, but current reserve levels just barely match nightly repo volumes. Anything less would risk instability. Reverse repos and the Treasury general account have been draining, temporarily boosting bank reserves. But this is a fragile equilibrium. The minute the Treasury starts issuing again, those gains will reverse. QT, quantitative tightening, adds further strain. In short, Fed officials are either misinformed or intentionally misleading. The math doesn't lie. If reserves fall below nightly repo activity, it could trigger financial chaos. Yet policymakers seem oddly detached from these critical mechanics.
Why does this happen? Why is it that if the Treasury does not raise money, bank reserves stay where they are? Well, you can see in these numbers, this is from the latest balance sheet numbers from the Fed H41 report of the balance sheet itself. You can see when total factors absorbing reserves go down, total bank reserves, reserve balances, go up by about the same amount, the difference being the QT amount. So if total factors absorbing reserves go down 67 billion and reserves go up 68 billion, the difference is the quantitative tightening amount, or the amount of securities that the Fed sold off in the last week. Why do the total factors go down? Primarily these two factors over here in the red rectangles. The first is reverse repurchase agreements, others. That's the reverse repos that I talk about often. They're down $25,989,000,000. Add to that here the U.S. Treasury general account. This is the Treasury's bank account of the Fed, down $23,642,000,000. That means they put $23,642,000,000 into the banking system, into the bank reserves, and it is down here and it is up here in reserves. So as long as these two numbers keep falling, bank reserves will rise. This number will turn to a positive, right? Once the Treasury starts raising money. Once that happens, we're going to see some problems in the aorta of the banking system. Platinum. Now I want to get into the meat of this silver report. We're going to talk about platinum, which is little silver. Platinum is seeing heavy deliveries so far this month. 3,140 contracts worth available for sale. That is the amount of platinum that is in the COMEX right now. You can see here that we have had already 3,195 contract deliveries. That is already more contracts than are available on the COMEX itself. And we see here that coming up in August, we have another 1,095 contracts that are still open. And August is not an active platinum contract. So these deliveries will likely be made. The platinum is not being sucked out of the COMEX yet. We're just seeing swaps of warrants for these contracts, but we'll see what happens when we actually get into a platinum shortage, which is probably why the price is rising so much. Probably has something to do with Russia, because Russia produces about 20% of the world's platinum, and it's not good for the platinum supply for the world to be at war with Russia. And ever since their fallout between Putin and Trump, it looks like platinum has been rising, perhaps for that reason.
On the COMEX, platinum deliveries are exceeding available contracts, a red flag for potential shortages. This isn't just paper shuffling, it's a sign of real demand surfacing. With Russia constrained by sanctions and geopolitical tensions, global supply is increasingly vulnerable. While current shortages are being masked through warrant swaps, the structure is showing signs of tension. Technical charts confirm a long-term breakout going back to 2008. If history repeats, we may see a return to a 15-to-1 silver-gold ratio, just as platinum races toward $5,000. These intermarket signals suggest we're nearing a critical pivot in the global monetary system.
Triangle price action going back to 2008. There is a definite, absolute breakout of this triangle going back to 2008. It looks pretty elegant here. We touched it in 2011, we touched it in 2020, and now we have broken out decisively. I don't think we're going to break back below into this triangle anytime soon. But here's the really exciting chart that I found on Gold Charts R Us. You can see here, this is the platinum price action going back to 1880. Actually, in 1880, platinum was $1 an ounce. Now it is 1,500, 1,450, something like that. We can see a very elegant trend line going back to 1890, about 135 years. I said 125 years, and I was wrong. It's 135 years. But here's the real interesting part. You can see here, whenever platinum reaches an apex going or threatening the upper side of these trend lines, you can see here that these are when silver to gold or gold to silver reaches around 15-to-1 or close to it. This happened in 1919 after the Great War. Some people call it World War I. After the Great War, so the gold to silver ratio was at 15-to-1 for the first time since 1873. And here again in 1980, as platinum hit this high on the upper side of this trading range in 1980. That's also when gold to silver was about 15 to 1. In 2008, it didn't exactly hit 15 to 1, but it got a lot closer than it is now. And if we look over here to where platinum would be if it hit the upper side of this trend line, or the top trend line of this trading range, it would be near $5,000. So my assumption, or my theory, is that when platinum hits $5,000, that's another indication that we are in the end game.
Japan is on the verge of something far more dangerous than recession: food-driven inflation. Official CPI may appear tame, but food prices tell the real story. Up 7.2% year-on-year, with rice alone soaring 100%. This mirrors the early stages of every modern hyperinflationary collapse, where food becomes the flashpoint. Meanwhile, the Bank of Japan is struggling to contain bond yields, which are repeatedly testing their 1.56% ceiling. A break above 2% could trigger a debt spiral and currency devaluation. The Bank of Japan's massive balance sheet, bloated from years of intervention, would implode under such pressure, accelerating the yen's downfall.
Now I want to look at Japan for a second. This is Japan food inflation, and in hyperinflation, the prices of nothing else matters as much as food, because if food prices are spiraling higher and higher and higher, even if real estate prices are going down, it doesn't matter, because what you need is food to survive. You don't necessarily need real estate. So here we have the food inflation stats for Japan. These came out, I think, 2 or 3 days ago. We are at 7.2%. And this is a serious uptick from last month. We can read in the paragraph here. Food prices in Japan rose 7.2% year-on-year in June 2025, accelerating from a 6.5% increase in the previous 2 months and pointing to the steepest pace since March. The key here is the end of this paragraph. It says here, as for staple foods, rice prices doubled, surging 100.2% year-on-year, holding near the fastest pace in over 50 years and highlighting the challenges facing government efforts to control food costs. In light of this, we have Japanese yields. This is the 10-year bond yield, where we have a ceiling of around 1.56. It has been hit 1, 2, 3, 4, 5 times. It's going to break through. When it does, we got to get to 2% in order to see a major breakout to 1980s, 1970s levels. We're going to get there, and when we do, the Japanese bank, or Bank of Japan's balance sheet, is going to get destroyed, and so is the value of the yen.